Welcome back to New Money. We're discussing retirement and financial planning. My guests are Daryl Bennett, who's run away after I left him that question, and Jordan Toy. If you'd like to email me, my email address is info@anchorcapital.co.za. Okay, I'm going to let you off the hook.
Can I divert from that?
Yes, I'm going to.
So allow me to divert.
Yeah, I'm going to allow you.
Instead of saying 20, 30, 40, I like to look at the expenses. I like to meet with the client and say, right, let's look at your expenses. What are you spending money on? Because, you know, sometimes if you drill down to the expenses and you find out a little bit more about the client and what they want and what they're spending, you might be able to trim down that expense number. Because when you get into retirement, besides your capital and your income, your expenses is very, very important. So if you can get into a habit of spending as little as possible, be as reasonable, it gives you a better chance to retire. Now, what that percentage is, Bryan, for a 20, 30, 40-year-old, as I said, the younger you start saving, the better, okay? And the older you retire, the better. But yes, 7.5% to begin with is great. If you can afford to go 27.5% of your taxable income, the receiver will give you all that as a tax break. Maybe you can if you're unencumbered. Maybe you can't if you're newlywed and you've got a young child and you've got a mortgage bond. So everybody is different. It's difficult to box everybody as what you would put away in your 20s, 30s, 40s, 50s. So I can't give you an exact
So let me say
answer.
this to you. If a youngster, Jordan maybe, if a youngster puts away in their 20s to 30s, puts away 7.5% a month, 7.5% a year of their income, and increases that twofold. One, by a rate of inflation, and whatever increase they get in terms of income, they add that to the 7.5%. Will they have enough at retirement?
Look, not having run the numbers and taken a detailed look at it, I mean, off the top of my head, it does sound like you accounting for inflation. So you're going to ensure that you are growing your retirement savings somewhat. But what I think would be an interesting thing to look at is, obviously, as you age, you would expect to earn more. Maybe your expenses increase, but hopefully not as fast. And the 7.5% near the end of your career in the sort of the absolute rand amount is going to be significantly more than in the early days, but there's going to be less compounding. So I'd love to actually run the numbers there.
I was going to say, you need to look at the model, but another thing you've got to be very, very careful of, and all these models, unfortunately, when you're planning and you're extrapolating going forward, you've got static data on your assumptions. And inflation, as we know, is a major, major risk. And it defaults on all these financial planning tools to the statutory, to what the government tell us is inflation, 4.5 or 5%. But each individual could have a different inflation. Their medical aid, their basket of goods might be different to the basket of goods that our government uses to extrapolate what an inflation is. So we've got to be careful when you bandy about the word inflation.
I agree with you. Everyone's circumstances are different.
Yeah.
But I can tell you, I have run the numbers.
Okay.
7.5% for a 25-year-old will be sufficient.
If he retires at what age?
65. 27.5% at a 45-year-old won't be enough, because you made
lost out
on compounding
time.
interest.
Yeah.
And then, you know, how much risk can you take? You're limited to risk in terms of retirement funds.
But that's why it's different conversations are required. Sometimes retirement, I'm sorry to say, is a myth. I know we've got the retirement funding and we've got retirement annuities, but in some people's lives it could be a myth.
Yeah. Daryl, AI? How's it going to impact on our industry?
I think AI is great. I think AI is all about the prompt. It's the questions you ask it, and I think it will be able to work with us. As it goes along, I think AI will be able to resolve certain softer issues with clients. And I also think when there's objections from clients and you get to understand the client, it may help us and guide us. It will help us in putting report writing towards the clients. But at the end of the day, people, if they want that human touch, they're going to want the human touch. They want to sit in front of Bryan or in front of Jordan, and that is the way it's going to be. So AI is, you are going to have clients who want to work with the robo-advisor. And all these big institutions and banks will beef themselves up with AI and the robo-advisor if they don't want the human touch. But if they want the human touch sitting face to face, then I suppose you've got to leave the AI out the conversation.
Daryl, like the driverless cars that Tesla have, maybe there'll be a robot sitting where I am asking questions of you guys. We'll still need you guys, or do you think we'll have 3 computers? But Jordan, the large percentage of people still don't have wills. Why? Every time I read a newspaper, I talk about the importance of will. Every time I listen to a financial
That's
program,
another myth. They've got a will with the state. They don't have a will. They've got a will with the state.
Okay.
Testate.
Well, that well said, Daryl. Yeah.
I think it's something, I think first and foremost is something nobody likes to picture, right? Nobody wants to think of their own sort of mortality, and that, you know, that ultimately we will all pass away. And I think it's something we naturally, as people, all prefer not to think about, or think that it won't happen to me. But yes, we do have a big problem in terms of the lack of wills.
Okay, let's get to our emails. Philippa in KZN, this one's for you, Daryl. Do I take money out of my bond to go offshore?
I don't know how old Philippa is. I don't know what other assets she's got, but the general
I can
rule...
see Philippa saw you sitting here.
The general rule is that debt destroys wealth. It's not going away. You don't get a tax break in putting into the mortgage bond. So if it's 11 or 12% and you're a 40% taxpayer, the debt is costing you 16, 17%. So it makes sense to reduce the debt. Otherwise, you're gambling. You kind of say, I'm going to get a better return offshore, convert it back to rands than what I'll get on what the interest rate is charging.
Whereas I know
what happens if the market crashes?
Yeah, whereas I know what my bond rate is costing me.
Correct.
So we all agree, I think. You
pay off
Jordan?
debt.
Okay. Then Jordan, Errol in Johannesburg says, I've never contributed to retirement annuity, and for this reason I'm unable to utilize the 500,000 tax-free allowed at retirement. I'm still paying a large amount of tax. Is there anything I can do?
So there's a number of things Errol can do. He's ruled out the retirement annuity already. The other option...
Can I just stop you there? Because I think this is a question that so many of our viewers should be thinking about. They haven't used the 500,000. It comes in two forms. If you get retrenched, you can use it, and if you reach retirement. You can't get both, it's one or the other. But when people reach retirement and they take their 1/3 in cash, you get up to 500,000, 550,000 tax-free. So now, they haven't used this 550.
So naturally, you know, the earlier you start investing, the more likely you are to accumulate enough wealth that you can use that full 550. Let's assume, okay, Errol's not used the 550, he's not got a retirement annuity. There's still other retirement accounts that you may have just, you know, that you've accumulated through your working life, whether it's a pension, provident. There are some differences, but by and large, they function very similarly. So that is still an option if Errol's contributing out of his monthly paycheck, that there is some benefit that he's going to acquire from that. Outside of, and that's specifically from an income tax perspective. He hasn't mentioned the tax, but I assume he's talking to income tax. You know, from a different tax perspective, there are options we can look at in the investment space, right? What structures we use to house investments to, you know, if we're talking capital gains, taxes on dividends, interest, there are different options there that can help on those specific taxes. They might not help you with your income tax. For example, a tax-free savings is another option. Offshore endowments are something you could look at as well. But you know, a primary route is the retirement annuity, or any of those retirement type accounts. Obviously has a very direct impact on your income tax. There are a couple other levers you can look at pulling when you are trying to optimize your tax.
And there are also retirement annuities, contribution to retirement fund. You said 27.5%. Maximum.
Exactly. And if you've got more cash flow and you can put more than the 27.5%, the contributions you don't get as a deduction going in, you'll get coming out.
Okay, but there are other techniques, and I'll tell you the techniques I've used. There are three things you need to understand. If your retirement annuity is under 247,500, you can take it in cash. 2, you're allowed to contribute up to 27,500. 27.5%, and 3, you mustn't have more than one contract with an insurer. So let me explain. You take out 150,000 Rand retirement annuity with one insurer, because let's assume you've got taxable income of R1 million. You're allowed to put in 27.5%, which is 275,000 Rand. You put 137.5 with one insurer into a retirement annuity. You put 137,500 with another insurer. You put it in by the 28th of February. On the 1st of March, you can draw that money out. So, look, rule number 1, is it under 247,500 with the insurer? The answer is yes. So you can take out the 137.5. 2, have you used up your 500,000? No. So that's tax-free. So you can put taxable income in before the end of February. You can draw it out the next day, tax-free, as long as you, number 1, you've got enough income, and it's also rental income. It's not interest income. It's certainly and even other, well, you wouldn't have other retirement income. So you need to talk to your financial advisor, but there are techniques you can use. Yanni in Germiston says, I'm 50 years old and withdrawing from my company pension, and after 20 years of service, please explain the various options available. We don't have a lot of time, but just explain.
He's leaving the company, so if he doesn't need the money, first prize would be to preserve it so that he doesn't pay any tax. So he takes that benefit, that lump sum, and he puts it in a preservation fund.
Just say he's 54. So he's under 55.
So he's under 55. If he was older, he could still preserve it, but he then has the option when he's 55 if he wants to retire from it. He could withdraw the funds, but that's not advisable because he'll be taxed on the withdrawal options. And the third option is if the fund allows to be a retained member, he could stay in the pension fund. A lot of the new funds today allow members who are being retrenched or who are resigning or who are retiring to keep their benefits in the fund, Brian. So those are the options. You keep it in the fund, you preserve the benefits, or you withdraw the benefits.
Okay, I think we're going to deal with more on that program, next program. Jordan, I also want to do more on the two-pot system in the next program, which was signed into a bill last Saturday, 1st of June, 2 days after the election. Seems very strange to me. It's likely that most funds that South Africans will accumulate during their lifetime will come from their retirement pot. It may not equal the value of your home, but the house is where you live and will not just generate income. Your retirement funds are there to provide you with what I call a living wage during your retirement. The challenges ahead for retirees are longevity and inflation. There are investment risks you need to take into account when investing funds to counteract the two challenges. However, I've noted recently that retirees' behavior towards money is gaining popularity in buying new cars, alterations, or even changing homes, and then when children need money, lending money to their children. There are three important components that need to be considered when you retire: having no debt, a house paid for, and a good healthcare program. I liken this to buying short-term insurance when you understand what you're insured for, having a claim before which may not be covered. When it comes to retirement, evaluate where you are, where your current savings are going to take you, and what you still need to do. Rather know these numbers now than reach your retirement. Guys, once again, thank you for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program, we'll be doing a rerun of the estate planning show that was aired on Monday the 3rd June, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.